What if the biggest emerging market story of the next decade has almost nothing to do with China? Meet RISE, the Pictet, Emerging Markets Rising Economies ETF. It just launched on April 22, 2026, and it's the first U.S.-listed emerging markets equity fund from Pictet, one of the largest asset managers in Europe. The fund is brand new. It's only got around $9.5 million in assets so far, but the timing is striking. Investors have been pulling away from China-heavy emerging markets indexes for years, and Pictet is leaning right into that rotation with a fund that won't own a single Chinese, Korean, or Taiwanese stock. Here's how RISE actually works. It's an actively managed fund, not an index tracker. The portfolio managers focus on emerging markets countries with one specific feature: a growing working-age population. That's the demographic dividend, the idea that economies with more young workers entering the labor force are set up for decades of structural growth. That filter sweeps out the three biggest names in traditional emerging markets indexes. China, Korea, and Taiwan all face shrinking workforces. So instead, RISE tilts heavily into India, Brazil, South Africa, and other dynamic economies with younger populations and rising consumer classes. The sector mix is also very different from what most emerging markets investors are used to. There's much less technology and much more in financials, industrials, materials, and consumer goods. It's a more old economy, value-oriented portfolio designed to capture growth from below the surface. Now here's the catch. RISE charges a 73 basis point expense ratio. That's expensive. Vanguard's VWO charges 7 basis points. iShares EMXC, the ex-China Emerging Markets Fund, charges around 18. RISE is asking you to pay 4 to 10 times more for active management. So why does the fee even exist? Pictet's argument is that an actively managed, demographics-focused approach is hard to replicate with a cheap index. The teachable lesson here is simple. Whenever you pay up for an active fund, you're not just paying for exposure. You're paying for the manager's edge to outweigh the fee drag. That's a high bar, especially in emerging markets where active managers have a long history of underperforming after costs. Because the fund is only a few weeks old, there's no real performance track record yet, but the broader China-free emerging markets trade has been one of the better diversification stories of the past 2 years, as global investors look for growth that isn't tied to Beijing. Who is RISE actually for? It's for investors who want emerging markets exposure but feel uncomfortable with how much of their EM allocation ends up in China. It's for people who buy into the demographic dividend thesis. And it's for investors who are willing to pay for an active manager rather than just owning the index. One honest reality check. Brand new ETFs with tiny asset bases can be slow to trade and can carry wider spreads. And active management in emerging markets is a notoriously tough place to earn back your fees over the long run. If you want more breakdowns of new ETFs the moment they launch, smash the like button and subscribe. And drop a comment with your take. Are you bullish on emerging markets without China? Or do India, Brazil, and South Africa carry their own risks worth worrying about?